welcome back to the part 3 of chapter 12, and we're going to focus on earning persistency and earning quality. So first of all, we wanted to distinguish the persistent earning from one-time items, right? So earning persistence, what does that mean? It means whether current earning that will continue or persist in the future years. And one-time income items stands for certain items in the income statement are part of net income in the current year, but cannot be expected in the future because it's only happened once a while, one time. So therefore, we want to understand what kind of items in income statement are one-time item. Okay. First of all, discontinued operation. Discontinued operation is a business or a component of business that organization has already discontinued or planning to discontinue. And income from discontinued operation in the current year is reported separately from income from continuing operation. This allows investors to differentiate or exclude discontinued operation in their estimates of the future. So, in other words, sales or disposal of business or component business representing a strategic shift that has major effect on our organization's operation and financial results because it's discontinued, right? Only disposal of a business representing a strategic shift that have a major effect on our organization's operation and financial results are reported in the discontinued operation. The example shows, so if you want to put anything into this segment of the income statement, you got to make sure that it's only the sales or disposal of a business component can whether it's result in gain or losses can go into this section. And the example is major geography area of discontinuity, major line of business discontinue, or major investments you dispose, right? Okay, so let's say, for example, let's consider a sports apparel, let's say Under Armour, have a two business activity, a very profit line and not that profit line, or such as tennis shoes. Let's say that during 2021, the company decided to sell the tennis shoe operation to his competitor, and tennis shoe business has income for the year, including gains and losses on the discontinued operation in the current year are reported separately, right? For example, you will report income from the tennis shoe operation in the segment of discontinued operation, and then you wanted to report that the tennis shoe operation net income, right, inside the disposed segment of income. Net income is reported in the discontinued operation segment, okay, and net of sales, okay. And also, if you discontinue this operation, you must be either sell them or right, or you just really dispose it. So if you dispose it, you might incur loss or gains, and that is also part of the discontinued operation in the net income, in the income statements. So let's look at one. So let's say Federal Sports Apparel, that's imagination, like fake company. So in the 2021, it has a $5 million of net income, but if you look very carefully, only $4 million coming from a continuing operation, and then there's $1 million coming from a discontinued operation, and it says income from disposal of tennis shoe segment net of tax. Okay, so there's also other kind of revenue and expenses, such as loss due to write down of receivables, gain and losses on sale of long-term assets, losses due to employment strike, or losses due to business reconstruction, or uninsured losses from natural disasters such as flood, earthquake, and hurricane. So there are many other revenue and expense activity are not expected to reoccur. Not reoccur oftenly, right? So like always there's not always you're gonna you're gonna lose money for reconstruction, or you're gonna lose money due to a natural disaster. That kind of things happen, but not quite often. But no matter how unusual and how unoften these items is, they are not allowed to be part of discontinued operation. Okay, discontinued operation, namely, you got to only report the operation that you disposed or you sold, and these items, this activity or many other activity might not happen very often, but you cannot park them under the discontinued operation. Okay, they are part of continuing operation. They are not, but they just not under operating income. They are under other revenue and expenses item line, right? They must report as part of continuing operation, but not operational income. Remember, we talk about multi-step income. They are not in here, but they are part of continuing operation, but they are part of other income and expenses. Okay, so let's look at this. Which of following items would be reported at the bottom of income statement just before income, net income? Of course, discontinued operation, right? That's what we saw on the example. Okay, so this is what I consider most interesting learning objective of this chapter, is to distinguish conservative and aggressive accounting practice, and then which we will introduce of a concept about earnings quality. And I have spending my doctoral study reading a lot of seminar paper about how to judge companies' aggressiveness and conservativeness, and how to evaluate whether companies earning whatever you report as the net income is actually high quality income or low quality income. And now you probably questioning, what do you mean quality? How come earning has quality? Okay, here you go. Let's look together. Quality of earning. What do you mean? It means ability of reporting the earning to reflecting the true earning. In other words, it means ability. If you report $1 million of net income, we always, the reporter and the management and the investors always have a question, especially investors. They always question how true this $1 million of net income is really representing the truth of the operation of the company, right? Or you can understanding whether the reported $1 million is useful or not to predict future earnings of the company. If this $1 million is actually a useful number, then that means I can rely on this $1 million to predict the next year it could be 1.2 million, right? Because there's expansion of the product line, there's a promised growth rate of 2%, 20%. But if this $1 million is actually not really reflecting the true earning of the company, then I cannot use this to predict the future, right? Because I'm not sure whether this $1 million, how much it's recurring, how much is non-recurring, right? How aggressive this $1 million is recorded at, or how conservative this $1 million is. So the usefulness of reported earning to predict the future earnings is the conservative accounting practice will result in lower income and lower assets and higher liabilities. And so therefore, whether that's useful, we wanted to judge based on the two dimensions. Are you being conservative or are you being aggressive, right? So conservative accounting practice usually will report $1 million representing the result of lower income or lower assets or higher liability practice. But aggressive accounting practice will result in a reporting practice that is always reporting higher than what it actually earned and higher asset than what is actually the company has and lower liability than what the actually company owe. So there's a two distinctive attitudes or policy or strategy that business owners are trying to convey to the investors, right? They can be very conservative, always reporting bad news and then lowest possibility of things happen. And could be a very aggressive reporter that always reporting the best scenario towards investors. So let's look at this. There's a financial statement of this Federal Sports Apparel prepared by Mr. Nadal, and then he prepared this balance sheet. Okay, I want you to remember two numbers. Okay, one number is what is net income, and one number is what the 2022's total equity and total assets reported by Mr. Nadal. So Nadal saying that Nadal say that the income statement of this sports company is about $850,000, right? And the balance sheet is about total asset about $15 million. Okay, and the statement of cash flow is $2,300,000 related to the cash of the ending period, and the changing cash, okay, for 2022 is about 1.5 million, and then that's result in the increasing about 5 million net cash, hence that the ending balance of the cash is 2.3 million. So there's another person who is an advisor or also CFO of the company called Mr. Djokovic. And then he looked at Mr. Nadal's preparation of financial statement. He proposed the following changes. First, he says estimation related to estimation of bad debt. His concern is that at the end of the 2022, Mr. Nadal estimated the future bad debt will be about 6% to 10% of current accounts receivable. And he decided to play it very safe and recorded allowance equals 10% of accounts receivable balance, which is $150,000. And Mr. Djokovic proposed that changing this estimation to only 6% of accounts receivable, which is $90,000. And this change will result in increase in net accounts receivable and decrease in a bad debt expense of about $60,000. So remember, when we record a bad debt, we actually debit bad debt expenses, and then we credit allowance for uncollectible account, right? And then Nadal think there should be $150,000 of bad debt recognition for this year, and Mr. Djokovic said, whoa, let's take the lower end, which we only estimated about 6% of the accounts receivable we're not going to collect instead of 10%. Okay, this is the first item Djokovic proposed to change. And second item, he said write down the inventory. Mr. Nadal recorded about a $200,000 write down the inventory because remember the lower costs of market value, right? We say that if you always need to recheck how is the market considering inventory versus the book cost, right? And then usually we have a method of taking the lower one in the inventory chapter. And then Mr. Nadal said is very conservative. He writes down inventory loss of value of 200,000 and then write down the inventory about 200,000. And Mr. Djokovic insisted the write-down was not necessary because the decline in the inventory value was only temporary. Hence that he proposed to eliminate these journal entries, which would increase the inventory and decrease loss of the inventory write-down by 200,000. Also, Mr. Djokovic also proposed a third change, which is changing the depreciation estimates. So for building purchase for 11 million at the beginning of 2021, Mr. Nadal recorded depreciation expenses for 1 million in 2021 and 1 million in 2022 using a straight line method over 10 years with estimated salvage value of 1 million. And then beginning in 2022, Mr. Djokovic proposed that calculating depreciation over a total asset of 20 years instead of 10 years and using an estimated salvage value of 500,000. So in other words, Mr. Djokovic extending the useful year of that machine, right, from 10 years to 20 years, and Mr. Nadal only think that machine is useful for 10 years, and Djokovic say, wow, it can be used for 20 years, and salvage value is actually lower. This changes decreased accumulated depreciation expenses in 2022 by 500,000, right? And loss of contingency is the fourth item Mr. Djokovic trying to propose to change. The situation is that at the end of 2022, the company's lawyer advised Mr. Nadal that there is a 70% chances they were losing a litigation suit of 1.5 million filed against the company. Mr. Nadal recorded the possible loss as following. He considered 70% chances losing a litigation suit as a probable, right? We said a probable and estimatable is going to be recognized as loss contingent. And we're going to journal entry it by debiting loss and credit loss liability of 1.5 million. However, Mr. Djokovic argues that the likelihood of losing the litigation is actually not probable, is reasonable possible. So in other words, in Djokovic's mind, 70% is not high enough to consider a loss yet, right? But not probable. Therefore, he proposed to removing the litigation entry from accounting records, and this will remove the loss and decrease the liability about $1.5 million. So, if we adopt Mr. Djokovic's approach, we find that we will decrease in operating expenses based on Nadal's preparation. So this set is Nadal's income statements, right? Hence that Djokovic, if we really take on Djokovic's proposal, then the operating expenses is going to reduce to 60,000 and resulting in 1.5 million. Depreciation expense is going to decrease to 500,000, and inventory write down is just a whole 100% not a write off, right? They don't Djokovic don't write off anything of inventory, and Djokovic don't recognize any contingent loss. Hence, that income before tax is a increase from 1.3 million to 3.5 million. And the income tax expenses doesn't change because the taxable income doesn't change regarding this adjustment. Hence, then the net income Nadal reports 850,000, and Djokovic reported 3.1 million. What a drastic change, right? Okay, and then when we look at the balance sheet, amazing changes as well. Nadal reported $15 million for the total asset. After Djokovic's proposal, the total asset grow from 15 million to 16 million, and total liability and equity is growing same amount, right? And what about the adjustment effects on the statement of cash flow? As you can see, the net cash flow from operating activity, although there's a certain adjustment, but no matter is Nadal or Djokovic, is stayed at 1.7 million. So there's no difference between the statement of cash flow from operating activity. It certainly didn't have any changing for the financing activity either. So the cash at the end of the period for the cash flow statement, no matter using Nadal's method or Djokovic's method, they all equals 2.3 million. So I wanted to review our symbolism. Mr. Nadal is actually, if you properly recognize already, right? Mr. Nadal and Djokovic are names of a famous tennis player, right? However, they are also used here to symbolize important accounting concepts. Mr. Nadal representing conservative accounting practice and Mr. Djokovic representing aggressive accounting practice, right? Conservative accounting practice are those that result in a lower income, lower asset, and higher liability, and larger estimation of accounts allowance for uncollectible accounts, write down overvalued assets, and use of short useful life of the assets, and recording contingent litigation loss immediately, right? This is a conservative income, a conservative accounting practice. Mr. Djokovic representing aggressive accounting practice. If you recall, Mr. Djokovic proposed lower estimation of uncollectibles, right? And then he says a report, do not write down the inventory. And he also says a longer useful life of the assets. And then also it weighed the litigation loss become real, right? And so all this representing aggressiveness in terms of utilize accounting standards to. So none of them, I wanted to emphasize here, no matter you are being a conservative or you are being aggressive, you are both of them not breaching the financial standard, reporting standard of the GAAP. You know, GAAP didn't say Djokovic's method is wrong because Djokovic is still estimating uncollectible. Djokovic is still trying to reason why he didn't write down the inventory. Djokovic also still depreciated the asset. He did not depreciate the asset, right? He still depreciated. He just extending the life a little bit longer. And Djokovic didn't really recognize litigation because he believed 70% is not probable. And GAAP didn't say, oh, 70% it has to be considered as probable versus 90% can be considered as probable. GAAP just say, if you consider the situation is a probable loss, then you have to recognize the loss. And Nadal thinks 70% is high likely enough to be considered as a probable, right? And Djokovic might be thinking 90% is a probable, and 70% is just reasonably possible. Hence that both of them are not breaching GAAP or cheating against how the accounting should be conducted. It's because it's just a way, a strategy of how do you use accounting standards, right? So everyone involved in business, not just accountants, right, needs to recognize accounting is not a black or white, is not right or wrong business, right? If you lower your estimation, or you longer your useful life, or you do not recognize the litigation loss when you don't think it's probable, it's not black, it's not wrong. It still walk within the GAP's requirement. But it's representing a very aggressive accounting practices. In other words, the resulted net income, it might not be reliable. As an investor, if I read Djokovic's net income statement, I don't think the number that he reported can be used to predict the future earning ability of the company because it's not reflecting the truth, okay, or the true ability, right? So therefore, I wanted to convey a very important concept here in this lecture, is there are actually many gray areas in accounting. It requiring a lot of judgment and estimation in applying accounting principles. Okay, there's no black and white or right or wrong here. It's just whether someone is taking a more aggressive practice versus more conservative practice. Okay, so I wanted to emphasize that changes in accounting estimate and practice alter appearance amount reported in the income statement and balance sheet. However, those changes in income accounting estimation and practice usually does not have effect on the company's underlying cash flow. Okay, so let's see. Which following would be considered as aggressive accounting practice? Writing down inventory due to declining, that's a good thing to do, right? Changing from straight line to double declining balance method of depreciation, this is a good thing to do because I explained in chapter 7 that people using double declining because when you use it, you usually use at the beginning of the asset's life, which the new machine can generate a much higher income, right? Hence that you wanted to matching the costs with the revenue. Okay, so this is a conservative choices, right? Deciding removal a loss contingency while the likelihood of unfavorable decision is probable. Yes. So when you think about the likelihood of the litigation or loss contingency is probable, it's very important you to recognize it, not reason it out. You know, not finding excuses not to recognize that contingency. Okay, so chapter 12 is the last chapter of this book, and it's summarized a lot of things for us. First of all, it shows us how to do horizontal and vertical analysis, right? And we say the horizontal is actually comparing one number using either sales or total asset to comparing your how does each line item as a proportion of either total sales or total assets. And the vertical, we talk about the comparing the company with its history, right? So comparing today with myself yesterday, how much is my growth? And second portion of this lecture, we talk about the risk analysis. We talk about the liquidity risks and the solvency risk. And then we use the liquidity risks to measure ability of the company to pay the current debt and ability to converting current asset to cash. And solvency is comparing company's ability to pay long-term commitments, right? Number 3, we talk about the profitability analysis. So basically, we look at the ROA, ROE, and we can look at EPS, and we look at a PE ratio. Basically, we wanted to know per $1 of resources invested of this company, how much net income they can generating, right? Per $1 of common stockholders investing in the company, how much return it brings. And then this is most important financial ratio to indicating the company's performance of current year. And PE ratio is reflecting the market expectation of the company, right? It's either growth or it's a value company. And after that, we talk about what is earnings quality. Earnings quality is associated with the company's the reported earning on the balance sheet or income statement or cash flow, whether that can be used to the future earning prediction, right? Or it's persistent, right? Or it's replicatable, right? So therefore, earning quality reflecting the true picture of company's performance, right? And then we say to measure it, we also consider there's two kind of strategies. There is aggressive strategy and there is a conservative strategy, right? And then we said there's nothing breaking a rule or law about any this kind of attitude or strategy. Either you are being aggressive or you are being conservative, because the GAAP or accounting is not a concept or a discipline that has a right or wrong. It's not very clear in accounting. It's not a black or white. A lot of times it's a gray, right? A lot of gray areas because it involves judgment and estimation. So when you talk about judgment and estimation, it's very contextual, right? In this scenario, people can argue it's a way out of being conservative and then adopting aggressive, and then GAAP can do nothing about, SEC can do nothing about. But as investors, you might be hurt by aggressive accounting practice because whatever reporting into the net income is a number that you cannot trust, right? So that's a very interesting concept that I'm very happy that we covered in the end of this class. So I really appreciate, and I had a great semester with you guys, and I appreciate your attention and your hard working and efforts with me to learn this class. And I will see you either in advanced class, or I hope you take away with something with you from business perspective, or from logical perspective, or from understanding of money, understanding of company, understanding of financial reporting. Okay, thank you very much.